Hey everybody, thanks for joining us today. We're here to talk about deferred sales trust, answer some frequently asked questions, and appreciate you guys joining us. Welcome, Greg.
Morning, Paul. Good to be with you again.
So we got some slides up here today. We're going to go over some frequently asked questions that we get. Again, if anybody has any questions, feel free to put them in the chat. We're happy to answer them. A recording will also be sent out after the webinar. And if any follow-up questions, just email us. We'll get into contact info at the end, but let's dive right into it. So going into our slides, Greg, the first thing, deferred sales trust overview.
So, FAQs are really important because, just as described, it's what people want to know about. And so just so y'all know, we have even more in-depth number of these FAQs in the website. And so it's a great place to get acquainted or reacquainted or even to introduce it to clients and so forth. So, one of the first things is the DST is not new, but it's new to a lot of people. So folks are wondering, how long it's been around, what can you, tell me to demonstrate that it's legal, proven, and tested. And so, it's a 27-year track record, somewhere north of 4,000 transactions having been completed. There have been IRS audits. There have been direct IRS reviews. There's been peer review, FINRA deep dive review. And to date, 27 years in running, there has not been a single adverse finding or event for any of our clients. And so, the guesswork is really kind of taken out of it. And one of the things that we do provide to every client is standing behind what we do. So any DST engagement comes with an offer to basically to defend any potential audit at no cost to the customer for the life of the trust, whether it's 5 years, 10 years, 20 years, or beyond. And that's pretty much it. They also like to know who's really directly involved with their DST and supporting them. And that really is one of our tax attorneys, who I like to call the architects of this strategy, a licensed financial advisor who's been vetted, trained, and approved in this role, and also the independent trustee, which is our role here at Reef Point with myself and Paul and other members of our team. So that's just a little bit about the background, which is probably the most common question that we get.
That's right. Great overview. And again, as Greg mentioned, we're going to send the slides out as well later for people that have further questions, and that'll be on our website as well. So the second key question, Greg, can a deferred sales trust be used for the primary residence sale?
The answer to that is yes. And so the kind of the minimum viable transaction size where a DST makes good economic sense for you is really not based on the sales price. It's really based on the amount of the capital gains we can help you defer. And so that minimum amount of deferred gains is going to be $400,000 to possibly $450,000 or greater in capital gains. So let's say you bought property for $500,000 and you're selling it for $1 million. Well, just simply speaking, the taxable amount would be the gain of $500,000. Does that meet sort of the minimum requirement? Yes, it does. Also, that minimum capital gain amount can be made up by more than one sale that you're contemplating. What do you have? Two pieces of property or a business and a piece of property where maybe one on its own doesn't really meet that criteria, but both do. If they're sold within, say, 2-3 years of each other, and that meets kind of that minimum, then that's going to make economic sense for you. Now, in a single family residence, same thing applies. So you do have kind of the same minimum capital gain exposure, but remember that you may also qualify for what's known as the Section 121 exclusion from the gain on the sale of a primary residence. You will have to have lived in that residence any 2 of the preceding 5 years before the date of sale. And then if you're married, there's an exclusion of $250,000. Or you're single, I should say. If you're married, that exclusion could be up to $500,000 of your gain. So if I use that same example that I just used, we bought our house for $500,000 and we're selling it for $1 million, and I'm married and we've lived there at least the last 2 or 5 years, then our $500,000 exclusion on top of our cost basis would mean that we wouldn't have to pay any tax if we sell our property for $1 million. But what if we're selling our property for $2 million? That exclusion is only going to get us up to the first $1 million, effectively tax-free, and I'm going to owe tax on the next $1 million. So yes, the deferred sales trust can be used to help defer the capital gains taxes on the sale of a highly appreciated primary residence. And there's a number of things you can do. You may want to take out just enough to buy a replacement residence, but defer the tax on everything else. You may have other objectives. So definitely worth talking about.
Yeah. And just to add to that, we also prepare, a financial analysis for sellers that are saying, hey, maybe we're looking to downsize, right? And how do we take some cash out from the sale? And there's different ways to do that, up to your basis. So we kind of go through different strategies in advance of even closing to make sure that sellers can walk away with the most amount of money. If that's, for example, if they're downsizing, empty nesters, we kind of go through all those processes as well. So next question. We see a few questions coming in. We'll get to all these, here at the end. But Greg, can I use a 1031 exchange in combination with a deferred sales trust?
Yes, that is possible to be done, and we do have occasions where that is actually occurring. 1031 exchanges are almost, a competing strategy to the DST. Both of them can allow somebody to sell investment property and exchange for or trade up into another piece of investment property. The DST can help you do that. A 1031 exchange can help you do that. The difference between the two in that specific role is the DST can effectively allow you to park your money and wait for the right opportunity, where the 1031 exchange has very rigid timelines and deadlines that you must act under in order to qualify for deferral of the proceeds of the original sale. So, and with the DST, you don't have to replace the same amount of debt. You don't necessarily have to buy something for the same price or higher. You could sell a 50-unit apartment building, and maybe you want to do a partial transfer into a 25-unit apartment building. In a normal exchange, you wouldn't do that because you're going to be subject to boot and paying taxes. But the high-level question of, can a 1031 be used in combination with the deferred sales trust? There are situations where that does happen, can happen, and might make sense. But for the most part, it's comparing two vehicles and deciding where you're trying to go, what you're trying to accomplish, and deciding which vehicle best suits your needs. So, we think it's wise to explore both if we're talking about investment property, and we're more than happy to help you do the analysis on both sides of that.
Perfect. Yeah. Next question. Does the allocation matter when it comes to my business sale?
So this is a really, really good question. And it's something that is involved in business sales and larger business sales, like in the mergers and acquisition space, and often utilized, headed up by our business broker professionals and our M&A professionals. Now, there's two basic ways that you're going to sell a business. One's going to be an entity sale. One's going to be an asset sale. The entity sale is generally preferred by sellers, but not necessarily preferred by buyers. But they're buying the whole company, which includes maybe contracts that would be otherwise difficult to get, or the brand that business has bought. They want to continue with the name and the brand. They're not just buying the assets and the client list and moving on. An asset sale is where you break down your purchase price into different components, including goodwill, fixed plant equipment, inventory, and maybe some other issues. Now, in most cases, your professionals, it could be your business brokers, could be your CPAs, they may not be aware of the DST. They may not be aware that there is a solid tax deferral strategy that you can utilize in connection with your sale. Therefore, they operate under the assumption that, the sale of your business is going to be taxable, no two ways around it, right? But there is a way around it. So where does asset allocation matter when it comes to your business sale? So let's take in an entity sale, for the most part, it doesn't matter. But since most sales are actually asset sales, it definitely can matter. So here's where it matters. So when you're breaking down the components, goodwill, fully deferrable, inventory, and fixed plant equipment, you want to, as the seller, you would like the allocated value of that component to be equal to what you're carrying that on your books for. So you could have a dental practice where you've invested $100,000 in equipment, right? And then you're going to sell this business for $1.5 million. And but since you've owned the business, you've depreciated that equipment down to from 100 to say 10,000, right? Now you go to sell. Well, the buyer would love to allocate $100,000 of the 1.5 million total sale to that plant equipment. Why? Because they want to redepreciate your equipment based on its original value, not what the book value is that you've already written it off down to. Now, the DST and any other strategy really doesn't allow you to defer the profit that you make on fixed plant equipment. So, my example assumes that you're going to make a profit. It's like I've got a cost basis of 10,000, and if we allocate it at 100,000, I'm going to owe some tax on that profit of $90,000. So that's where a key piece of the negotiation is going to occur between the buyer and seller. And if your business broker is aware of this and you're pursuing tax deferral, such as through the deferred sales trust, you're going to pay closer attention to that than you otherwise would have in a transaction that everybody's just assuming we're just going to pay taxes. Our goal is that you're not going to make that assumption and you're not going to do that. So for purposes of this, that's an important piece of the negotiation. We'd love to kind of work with any business brokers or M&A folks out there before they really get down to the brass tacks of how that business is likely to be sold. And if it's an asset sale, think in terms of how you can have some negotiating points to try to get what the seller is most looking for. Okay, so great question.
So Greg, I'm selling a business. And I get the DST, it makes sense to me, but I have a carryback. Can I still do it? Can I still do a DST if I have a carryback on the sale of my business?
You absolutely can, and it is fairly common both in business sales and sometimes in real estate sales as well, where instead of receiving all of your sales proceeds, at the close in the year of sale, there may be a carryback. Or some of the sales price will be held back. There's, as Paul's indicated here on the slide, there's kind of three ways that happens. There could be a carryback, a holdback, or an earnout. So a carryback means that, maybe they're buying your business for $1.5 million and they're getting a $1 million loan from the SBA, and they've only got $250,000 in cash, and they're asking you to carry $250,000 as a second mortgage, so to speak, on the purchase of the business. That's known as a carryback. So the trust has the ability to take in that carryback note along with the cash proceeds and then redistribute income back to you that you need. So, for example, if the payment that the buyer's making on the carryback is really more in total than what your actual needs are, you could basically run that through the DST so that, let's say they're paying you $10,000 a month, but all you really need is $5,000, then that trust could receive that $10,000 a month tax-free and redirect $5,000 to you. So you're only paying taxes on the $5,000 that you actually need and not on the full amount. There's also the possibility that you could directly carry that note and receive the direct payments from the buyer. So it's flexible, and there's basically an analysis of what makes the most sense with the short discussion. Then there's what's known as a holdback. And a holdback, let's say it's an entity sale, and entity sales come with some liability risk for the buyer because they're buying the company. If something comes out of the woodwork and somebody sues the company, well, it's on their shoulders in the future because they bought the whole company, not just the assets of the company. And so there may frequently be a holdback of a certain percentage of the sales price for 1 year, 2 years, 3 years, at which point in time, if the seas are calm, skies are blue, then you're going to receive that money again. So absolutely, the trust can be structured and in the agreements that when the holdback becomes due, it comes right to the trust to help you defer the taxes. The third element here is typically an earnout, and an earnout is really where you're agreeing to stay on with the company as a consultant, usually on 1099 or W-2 wages, but it's earned income that you're going to be receiving. So earned income is typically not deferrable in this situation, but if there's a pretty hefty amount, there's always the possibility that you can negotiate a higher amount towards the sale and a lower amount towards the earnout, because you can defer, the goodwill in the sale as far as taxes, but you can't really defer the taxes so much on earned income. So those are the specific ways that those work and kind of what you can do in each scenario.
Got it. Very cool. So I get it. DST makes sense to me. I'm selling my business, but one of the key things I want to know about, Greg, is what is the role of the trustee? What is your role? What is Reef Point? Kind of walk me through that a little bit.
Okay. So we talked about the 3-member fiduciary team for every DST that we're involved in. That's one of our tax attorneys, ourselves as the independent trustee, and an independent financial advisor. So the trustee's role is really to undertake the initial consultations with clients to assess the transaction that they're expecting to proceed with, and to explain all aspects and elements of the DST to the best of our ability to the buyer, answer all their questions initially, but also to evaluate whether or not this makes economic sense, to provide maybe some analysis and illustrations associated with our fact finding, and then to sort of coordinate the process moving forward. We were going to coordinate and bring in the tax attorney for a deeper consultation and conversation about the transaction itself, and then help them get connected with your escrow, your title, your transaction attorney, whoever is sort of in the middle managing the sales and purchase agreement and due diligence aspects in the transaction, where we're going to be managing the tax side of it for the seller, and then bringing in the assigned financial advisor into the mix so that we can hold discussions about risk tolerance, what your needs are. I call it the payback structure or the payout structure. What are your needs from the trust? Do you need money at the close? Do you want a regular recurring payment amount? How do you feel about a strategy that involves the highest income you can possibly generate as safely as you can, or a combination of income and growth, and then start to put together some modeling around diversification of investments to meet your needs and obligations. Trustee also coordinates periodic reviews with the financial advisor and the client who now is the note holder in this scenario. So oftentimes we'll conduct quarterly review calls on Zoom with each client, unless they would prefer a different frequency. But that's another thing that we look to do. And also to be a sounding board for any other needs or future anticipated things that they see coming down the pike, how it might affect the DST. We might be looking to amend the amount of distributions that are coming your way, based on changes in your personal lifestyle or situation. So our role is to sort of be the quarterback to help manage all of those aspects moving forward.
Got it. Very cool. So we got a couple questions in the chat. I'm going to walk through them really quick, Greg. So number one, how does this approach differ from the monetized deferred trust crushed by the IRS, monetized installment sale? And how is this different from what life insurance companies offer?
Well, the monetized installment sale was a strategy purportedly based on the same code section, but completely different mechanically in their approach. Yeah. It involved, what the IRS finally determined was an illegal step transaction, meaning that it had a number of complicated steps that all had to work in concert to theoretically achieve the objective of deferring the taxes on the sale of your property. But as the the DST kind of went through its paces with audits from the IRS over the first 12 years of our existence. They came in to do a deep dive, requesting a week-long visit with our tax team, who they were requested to ship 10 years worth of tax records to the IRS in advance so that then it could review them in person. The same process occurred subsequent to the purveyors of the monetized installment sale, and they actually tried to fight the IRS. Instead of being cooperative and saying, yeah, we have confidence in what we're doing and we're happy to share it and explain everything we're doing to you, they kind of took a different tack. They tried to sue the IRS to prevent them from getting records and so on and so forth. So it took a little bit longer, but the IRS got what they needed, and they determined that their application, their particular mechanical approach to this was an illegal step transaction, and basically shut the door on it. It essentially involved a scenario whereby they were looking at it like a cash out refi as opposed to a sale. So they took a sale, tried to treat it as though it was a cash out refi, so that the seller actually got about 92% of their sales proceeds up front in cash at the time of sale. But there was still a promissory note, if you will, in the background, funded by bank letters of credit and financing that had to be paid based on the proceeds. So it was like a cash out refi, but they didn't still own the asset. So when the IRS came knocking to these folks, they say, well, let me get this straight. You sold your house. Yes. You got pretty much all the money in your hands that you control. Yes, that's correct. And why is it you think that you don't owe taxes at that point? And the answer was, because they told me so. That wasn't good enough. It did not work. Bottom line is, if you have total control or access to the money, or the money is in your hands, you're going to have to recognize and pay taxes on that. The idea between the deferred sales trust is to create an installment sale whereby the note and the payments are secured. The investments that back up your ability to receive your payments, earn the interest, and get your principal back over a time period that you desire is structured in a way that you only recognize and pay taxes on the money you receive from year to year. Imagine as though your money is sitting in your personal 401k plan. As long as you're not drawing money out of it, you're not paying taxes. But the moment you are drawing money, you're paying taxes only on what you happen to draw out of it. So the monetized installment sale pretty much got crushed. It's on the Dirty Dozen list now with the IRS, and it's not something that anybody should be exploring. Now, you asked about the insurance model, and that is a model that was developed many years ago by Allstate Life Insurance Company, who then later found it really wasn't that profitable, and they kind of got out of that business. And then a couple other companies have recently began to do a twist on kind of what the DST does. So it's an installment sale as well, but instead of having the flexibility over the amount of income that you wish to receive and how the money is invested, meaning that you could want the money invested in a very conservative fashion, or you could want it invested in an aggressive fashion, or anywhere in between, and have access to any asset classes with your money. That's more or less what the DST offers you. With the structured installment sale, which is really based on an insurance company backing this, is that you'll sell your property, the money will go to an insurance company to be held in its general fund. They will pay you a structured annuity payment for 20 years, typically. So they'll determine what that amount is, not you. And once that starts, you cannot change it. So you're going to get all your money back plus a rate of return over, and I think the amount of time is typically 20 years on that. But the problem with that, or the positive about that, is it should be very safe and secure. The investments that are in the general fund of an insurance company are very conservative, mostly bonds, a little bit of real estate, but mostly bonds and held long term. But that means that the underlying rate of return on the payment that you're going to be receiving is going to be very low and very conservative. So typically it's like taking an annuity from an insurance company that's paying you income for a period of time or for life, in this case, a period of time. And your average rate of return on your money is going to probably look more like 2 or 3%.
Yeah.
Not that much, but it's going to be pretty safe and secure. Now, could the DST do that? Well, yes. I mean, if you were very conservative, we could absolutely replicate a very conservative investment model consisting of government bonds, T-bills, treasuries, insured CDs, and the like, things that are considered very safe, guaranteed and or insured. We can replicate that with the DST. Most of our clients don't want that. They're willing to take a little bit more risk, have a little more flexibility, be able to defer payments for a while until they need them, to be able to define and identify the level of income that they want, and not just take a specific amount of money that is basically told to them. You might want to take partial interest payments. You might want to take interest-only payments or interest plus principal, and you may want the flexibility to potentially modify that level over time. The structured installment sale does not do that for you. The DST could. So in a nutshell, those are the three potential strategies that seemingly are operating in the same light.
Yeah, and then Brian asked a few questions about, the 450 number seems high in terms of the minimum viable transaction size. What if somebody's doing fix or flips, Greg? I mean, the question really is if somebody does a combined 4 properties in 12 months and they reach 450, is that still viable for a DST?
It's not only viable, but a large chunk of the sales proceeds from those can be redeployed back into new fix and flip opportunities. And so you're recycling the money. You're able to kind of recycle the money between the DST and typically there's going to be a separate structure created for a real estate type active real estate investment, which is going to be an LLC, which effectively creates a little mini syndication between yourself and the DST, where the DST is the investor and you're the syndicator. So you're the one identifying and managing and making decisions around the investment, how much to use to improve it, when to sell it, negotiations and all of that kind of stuff. But on each sale, we can kind of get involved in the escrow and we can defer the capital gains on that project back into the DST. And then you could be looking for another real estate project to invest in, more than one potentially. And then money from the DST can be used to help fund, recurring investments in that space. So that's an important question. And also from a syndication standpoint, what if you're already in a syndication with other investors? If your share of the capital gains in the purported sale of that meets sort of that minimum viable transaction size, then you could use the DST even if other partners in your syndication don't, without negatively impacting them. So that's another conversation that we can have if you have that situation occurring.
Yeah, a great question from Ruben. How long can you hold a DST? Can you use funds to purchase an opportunity in another state?
Absolutely, Ruben. Thanks for the question. The DST will initially be structured with a particular term that you're going to choose. Usually 10 years is the typical initial term, but it can be renewed or extended at your option as many times as you want. There is no statutory end date where all of the money has to come out to you and the taxes have to be paid. So if you wanted it to be a legacy asset and continue to operate and delivering income, including income on the taxes you otherwise would have paid back at the beginning for your family, then you can do that.
Yep. Brian's another question. Under what conditions could a syndicated real estate property in an LLC use the DST for deferring cap gains of a sale of an asset in the LLC? So say it's a large multifamily property. So if one member of the LLC reaches that 450 in net gain, can that member use the DST?
Yeah, thanks, Brian. So yeah, I just kind of maybe I skipped through, ahead, but I think I just alluded to that question. So if you've got a multiple ownership arrangement in a particular asset that's going to be sold, then any individual member could utilize the DST, provided it meets sort of the minimum kind of standards to make it attractive for you. The others can follow suit, or they don't have to. In this scenario, most of the time, each individual owner or seller is going to have their own DST so that they can chart their own destiny without being tied to the hip with their other partners moving forward. It doesn't mean that you can't both have a DST and then maybe both of you want to reinvest back into another active real estate project together. You can't, but you don't have to. So the beauty of this is that what also could be done, which is, I would say, much more rare, is it's possible that all of the partners of that LLC want to do one DST for the whole partnership. That would be closer to like somebody doing a 1031 exchange in their partnership, because you got to kind of make all the decisions together. And if your objectives and needs for income are different from your partners, that's why the flexibility of having individual DSTs for each individual owner is so important for us, because, as I said, it allows you to chart your own destiny without having to make joint decisions with other people that you were in business with. Make sense?
Yep. And then Brian's other question was about the key advantages of a DST over a 1031. I know you're going to dive into that really quick, Greg, but Brian will also be emailing out a webinar that we did talking about that as well. So, Greg, what are the key advantages of a DST over a 1031?
So, the first one I think is the ability to park your money and wait for the right deal, as opposed to, trying to identify property, within that short 45-day identification window in a 1031 that may not be ideal, right? And so one approach for using the DST is, could be a primary strategy that you want to pursue, or it could be your backup strategy. Maybe you want to test the waters at 1031 first. And if you can't find ideal replacement property, or you can't close in time, or you find out during the inspection phase that this is really not a property that you ultimately want, because there's more negative things going on with it than you knew from an initial drive-by and just examining the numbers. You don't really understand the condition of the property until you get into that due diligence phase, right? So it gives you an escape hash or insurance policy to be able to pivot out of that 1031 environment and into a DST. So having the ability to park your money. When I was a real estate professional, I coined a term for some clients that, we sold investment property. We're working through a 1031 exchange. Inventory may be limited, and maybe, we found something that fit the economic requirements that we needed, but maybe it was older than we liked, wasn't in the best area that we liked, but there was not much else that fit the requirements. And so, I'd have to kind of remind the client, I go, sometimes you just have to hold your nose and close, because the alternative is to have this exchange fail and you're going to pay taxes and take 2 steps back before you can take another step forward. So that's one of the key advantages. Use it as a backup strategy if you want. There's no upfront cost. So, put that insurance policy in your back pocket. It can actually help you on negotiating on the upside, because most sellers, when you're seeking the upside leg, they know you're in an exchange. They're not so willing to renegotiate, for repairs or credits or price adjustments, because they figure that if you don't buy their property, you're going to pay taxes. So they don't really feel like they need to negotiate or meet you in the middle. If you have an insurance policy in your back pocket, it can really help you in those negotiations. Number 2, a lot of times, if you're selling property you've owned for like 15 plus years, you've depreciated that property down pretty substantially. If you do a 1031 exchange, you're going to have to transfer that low basis laterally to the upside property, which means that, relatively speaking, you have dramatically less depreciation write-offs on the next property than you did proportionally on the first property. However, if you examine the economics around using the DST as your vehicle or a 1031 exchange, you might find that even going after the exact same property using the DST as your vehicle, you would have substantially more depreciation write-offs on the upside than if you use the 1031 as your exchange vehicle. So that's really the highlights of what I would say the comparisons are.
That's it. And then Brian, you'll also find that website, that link to that video on our website, our YouTube as well. And we'll make sure to email it out to you also. But appreciate everybody for joining us. Greg, thanks for walking everybody through all of that. And we'll get the replay sent out. If there's any questions, as always, feel free to reach out to us. We're always available. Reach our direct line, email us. We're here to answer your questions. So thanks for joining, Greg, and thanks for explaining everything.
Yep. Thanks for moderating, Paul. And, we're here to help, guys. So if you have any questions, let us know, and we're here for you.
On to the next. Thanks.
On to the next. All right. Take care, everybody.